So why small bay? So for anyone who hasn't really attended any of our industrial one-on-one webinars, Hanson, can you give us an idea of small bay and why we like it and why we're really focused on that area?
Absolutely. So small bay specifically being anywhere from 2,000 to 25,000, or alternatively, you could say anything that's under 25,000 square feet per bay or suite, essentially. If we're talking about industrial and we're specifically looking at the multi-tenant, we're looking at an asset that's going to perform almost more like an apartment building. The more tenants you can have, the more diversity we get. So these are the local infrastructure for the local economy. It's that last mile distribution, contractors, trades, service businesses, suppliers. Think most critically, these are groups that need proximity to rooftops. That's the underlying component of the thesis. And we'll dive a little bit deeper into that later.
Like, who are most of the typical small bay tenants and why are they sticky?
So that relates to Hanson's answer in terms of chasing residential growth. We're looking at markets that are seeing strong residential growth, and the typical tenants for small bay multi-tenant business parks are businesses that are servicing that residential growth. So think of trades, contractors that are servicing, pool contractor, plumbing contractor that's servicing that residential growth, as well as some last mile distribution uses, as well as suppliers that are supplying inventory or goods and services to the residential growth.
Cool. And then Hanson, why is small bay structurally undersupplied and what are you seeing on the construction side?
So we have a slide that we go over frequently that we didn't include today, but it shows the growth of inventory or industrial stock in the US over the past 5 years. And traditionally over the last, I'll say since the GFC, more importantly, the new supply side has typically been large, single tenant, like huge distribution type properties where the clear heights have gone from 14, 18, 20 feet historically in the industrial space to now we're seeing 32, even 48 foot clear. And that's the ceiling height. As your massive tenants like Amazon get more capable or technically sophisticated, the property type has shifted. So all of the supply has been buying on the outskirts of town, raw land, build huge million square foot stuff where you can build that really efficiently. All of your costs come down when you do that. Whereas the small bay is a lower density product just by nature because you're going to have multiple suites. You need drive aisles. It's like a low density structure and it hasn't penciled or made sense to build that. And you also need to do it infill or closer where these pockets of rooftops are. So when there's new stuff expanding, like in the Southeast Valley, you could go further out, but it's always going to be a little more in demand internal or more infill, meaning further from the outskirts and more internal to the city. This particular deal is in a very mature corridor of town where there's just no opportunity to put new supply online. And even if you could find the dirt, it wouldn't pencil economically to build a really low density project because costs are so high. They've gotten so high with inflation over the last decade. You would need to build a single large building to optimize the revenue on any site, which is fundamentally at odds with this particular business plan.
Right. So why does all that matter specifically for the deal that we're about to walk through today?
So all that matters specifically is because we're buying into that oversupply, right? It's a lot of the big box product, as Hanson mentioned, is 100,000 to million square foot plus developments that have been targeting those distribution style tenants. And that's created an oversupply scenario in the Phoenix metro. So you can see on the slide from a supply metrics or a vacancy metric standpoint, big box is hovering around a 16% vacancy rate versus small bay is much more compressed due to limited supply and increasing demand. It's hovering around, call it 6.5, 6.6%. Depending on which submarket you're looking at. Sometimes it gets even tighter than that. So why it matters for this particular opportunity is we're buying into the oversupply and then converting it into undersupplied product and a strong infill location at a very attractive basis.
Hanson, why Chandler, and can you walk us through the location of what the opportunity of what we're seeing here?
So Arizona as a whole is top 3 fastest growing in the country. But then more specifically to this corridor, this building's actually visible from the freeway. So it's at the intersection of the I-10 and Loop 202. So you're right through a major interchange at a corridor, and the Southeast Valley has some of the highest numbers of new house permits and new growth going on around it. In addition to that deep labor pool that's bringing, being at these intersections is where a lot of industrial tenants are going to want to be, because at the intersection of two major freeways, it's giving them the ability to go off in multiple directions, as opposed to being isolated at one end or the other. This is a true infill location.
And then we touched on it a little bit, Mike, but what are some of the tenants that you're expecting to attract for this submarket?
So this building's uniquely positioned for the reason that Hanson mentioned earlier. On most of the competing supply on the small bay side of things was developed in the 70s, 80s, maybe the 90s, and is much lower clear height. So call it anywhere from as low as 12-foot clear to maybe 20-foot clear is pretty standard for most of our competing product. And while not all users or tenants require higher clear height, there are some that are out there, and us having smaller bay format suites that has 36-foot clear, we're uniquely positioned to attract some last mile distribution uses, as well as some service style tenants that may have a larger storage requirement. And you also add to the fact that we have a lot of dock high loading, and majority of small bay product is all grade level loading. So having the ability to have a mix of grade level and dock high loading will service a lot of tenants that your historical or more traditional small bay product is not able to service. So we're anticipating a lot of smaller last mile distribution type uses alongside your typical trades or contractors that are your service type businesses. And then in addition, the location in the Southeast Valley is very close to the new Intel campus. And so we also anticipate maybe getting some drafting off of that Intel development and seeing some of their suppliers who may need some space as well.
That's a great point, Pike, because Intel Ocotillo, everybody's familiar with TSMC and the $500 billion worth of investment that's bringing to the U.S. It's putting the Phoenix market in general as one of the leaders for tech investment. But the Ocotillo expansion, which is at Intel, which is a mile and a half south of this site, has been listed as creating thousands of jobs, and it's making it one of the largest private sector investments in U.S. history. And as we're probably all familiar with the U.S. government's investment in Intel, this is an area where we know there's going to be continued investment. And not unrelated, as we've been working through this process and interviewing teams for the leasing of this project, we've had teams that are not getting the leasing or were not awarded the leasing on this project tell us how in demand this product type is. We're going to expand on it a little bit later, but the fact that it's got dock high as opposed to just grade level loading, that's like a needle in the haystack. It doesn't exist on the supply side today. So we're excited about that. And through that, we've had some people who are working on the Intel expansion project already approach our brokers on space.
I'm going to move on to the next page. So, Mike, you can talk a little bit about the building we're buying, what we're creating, what it looks like today, and what it'll look like moving forward. That'd be helpful.
Of course, man. So this will be a little bit long-winded, but I'll dive into what we're buying today. Is your traditional 100,000 square foot big box distribution building. It's vacant. It's part of the oversupplied segment of the market, like we talked about previously. What we're going to do is we're going to demise it into 10 separate bays. That allows us to have some diversified revenue streams and put it into the undersupplied segment of the market where there's stronger leasing demand due to much more limited supply alongside the growing demand. And so how we landed on and you can see it here, and we can send you this site plan as well if you have any further interest after this webinar. But essentially we demise the bays to be ranging anywhere from roughly 6,000 square feet up to 12,000 square feet. And a lot of thought went into how we're structuring these bays. First being, okay, where is our competition lying, right? And a lot of the competing product from a big box standpoint, the new development product, they're typically only demising down to as small as roughly 25,000 square feet. So right off the jump, we knew we wanted to do bay sizes smaller than 20,000 square feet, because if we did 20,000 square feet or greater, then we're going to be competing with greater supply and facing an uphill battle from a new supply standpoint. So we started off on wanting to be below 20,000 square feet, and then we started working with our architects as well as leasing brokers in the market to understand the layout that would be functional for tenants, right? And so we wanted to make sure that we had functional width, like each of these bays are going to have roughly 54 feet width alongside them, and then set up so they have strong turn radiuses for forklifts or where they're storing inventory, et cetera. So there's functional width, and then a layout of office to warehouse space, giving them a small warehouse with a couple bathrooms, one that services the office as well as a bathroom that services the warehouse. The size of the overhead doors from the internal access to each of the bays, to the location of the man doors, like every single step of this, we work closely with leasing brokers to make sure that we're maximizing functionality and increasing appeal to the maximum amount of tenants in the market, anywhere combined from bay size all the way to true functionality for the tenants themselves. And the goal of this product type is, hey, we're going to spec these out. And where we've had the most success in general with the small bay product that we own is we're speccing these out to be a format that works for 90% of the tenants in the market, knowing that it improves our lease up timeline. It speeds up or minimizes leasing timeline and improves lease rate. Even though it doesn't work for that 10% of the market, it may not work for that 10% of the market. Having something that's move-in ready today that works for 90% of the market gives us our best shot at minimizing downtime as well as in maximizing lease rate because the tenants need space today.
What type of physical improvements are planned for the facility?
Yeah, so along with the spec offices and restrooms, we're going to have the demising walls that separate the bays, and it's going to be all the way to the ceiling, so 36-foot high demising walls. We're going to include 100% HVAC, and then again, improved lighting, fixtures, and very clean, modern office setups.
Hanson, you've done this before with another property not too far from here in McKinney. Can you talk a little bit about what you learned from the execution there and how it applies to this project?
The McKinney project we closed last July or August. It was the same business plan. It was a single tenant vacant building that we demised into. In that case, it was about 45,000 feet. We turned it into 5 bays, and it's currently 100% occupied. That took approximately a year from going into contract. We put that building in contract last January. We had it 100% occupied this January. We didn't close on it until the end of July. So we have confidence in the demand, or we've proven this thesis more than once on the conversion. But I think, to paraphrase what Chris Pike said, is the product that we're delivering to the market here is a very intentional design that's born out of a lot of extensive conversations with not just the users, because we already have several hundred tenants in the small bay space, but also and we're managing those ourselves, but also the entire broker community and the architects watching the new product that's coming online and being intentional with that. So what Pike didn't mention is this product and what we're converting, just like we did at McKinney, is those spec build outs at this size in the marketplace. Bigger tenants, they'll work with you because they're planning their space 12, 18, 24 months out. These tenants sometimes will be, hey, we need space. We were operating out of the garage and now we're going to an official space at the low end. Or it could be somebody who just doesn't plan as ahead because these aren't as big of operating companies as maybe credit tenants are used to. So having everything ready and designed around exactly what's in demand in the marketplace is what differentiates it. And that's where we have a lot of confidence in this. This isn't a budget that we're operating on and hoping we can hit it. This is the same contractor that does lots and lots of projects for us. We're very involved in managing those subs, not to take away from their own ability, but whenever we don't like the numbers on any specific trade, we'll go send a couple more trades. Just every component of this has been worked through and done before. It's not speculation.
2 quick questions from the audience. First one, Pike, are the tenants of small bay units leasing as triple net? And then the second, how will tenants access their offices and what's the door access on the back of the building?
So the tenants for this specific project, the answer is yes, we will be leasing these bays as triple net leases. It's a little bit more complex if you're talking market wide, right? Like depending on who the ownership is. Sometimes they're leasing as triple net leases, and sometimes they're leasing as gross or modified gross leases. And it's also dependent on submarkets as well. So it varies submarket to submarket, but in the Phoenix metro, it's very common to lease these small bay units on a triple net basis. And that would be the plan. And that's what we're doing on these bays, specifically is triple net leases.
So then the other one was, how are our tenants going to access the offices? Maybe if you want to talk about the common area up in the front.
If you can, as Ted's pointing that out, we do have a common area that there's a main access to the building from the front of the building. And then there's a shared common area that's a general hallway that has some shared dock high loading, where we will have these people access their office spaces rather than coming in from the front of the building itself.
And then there's door access on the back of the building as well, right? Probably.
Yeah, so there's overhead door access, and it's a little bit harder to see here as well. It's part of the municipality requirement. We have to have ingress and egress, both from the warehouse as well as from the office itself. And so we have man doors at the rear of each of these as well. You can see some concrete stairways and ramps if you zoom in on the plan, but it's a little bit difficult to see in the PowerPoint. So there is man doors as well as some dock high loading in the back as well.
Perfect. So let's get through the numbers a little bit. Hanson, can you talk us through some of the key numbers like purchase price, capitalization, and basis per square foot here?
Sure. So 12.5 acquisition price, total budget is about 4.8 million. That's a combination of the lending fees, the leasing commissions, the TIs, all that, for total capitalization around 17.3. Our acquisition price at $119 a foot is absolutely irreplaceable. We haven't seen a property anywhere near this caliber or even worse than trade at that price in the last several years in the Southeast Valley. With our underwritten rents, we're running to like $1.35, which is lower than the current comps of newer product that's being done. We stabilized to an 8.5 yield on cost. That's a phenomenal number. Our internal target is if we can stabilize above 8s, we love that. Those are buy signals for us. On the 2-year execution, we're running a 16 IRR and a 1.34 equity multiple. That's the high level of those numbers.
Like, how does the $119 a square foot purchase price compare to what you're seeing in terms of replacement and other recent sales in the submarket?
So in terms of replacement costs, our purchase basis at $119 a square foot is significantly below replacement costs. We would estimate replacement of this structure today closer to $240 a square foot. And that'll vary depending on the submarket you're in and the price of dirt, if there is dirt available, alongside how you're demising the property. But if we were trying to recreate this product in this market, we estimate a very conservative $240 a square foot. So we're about half of replacement cost at our purchase basis today. And then in terms of what we're seeing in the market, this sale comp is the lowest price sale comp for industrial distribution product that we've seen in the Southeast Valley. So in terms of replacement costs as well as market comp standpoint, we're at the very bottom end of both of those.
Well, then we had a question on what the debt structure looks like on this purchase.
So we're doing this purchase on an all cash basis. We're running this whole deal on an all cash basis as of today. So no debt's being applied. You will dive into that further on the rationale behind
I'll
why.
just jump into that. And I think it's worth differentiating or distinguishing that basis of $119 a foot, that's purchased on the existing structure. When we add in the rest of our total budget, we still come in to about a $164 a foot all-in basis. So we think after we've leased up, stabilized, accounted for all expenses, we'll be at about a $164 all-in basis relative to that marketplace where we're seeing the comps in the $240 to $270. So again, a substantial discount to that. It's actually part of why we're doing all cash. We view the risk to heavy reconfiguration deal as always the bank. So could we get a levered return to produce a higher IRR? Yes, we could, right? But we're choosing to do it all cash because we think that the uncertainty in the marketplace today, whether we're going to go up or down, cap rates go up or down, gives us enough pause to say there's no reason to go take on variable rate debt and be feeding interest while we're doing this. While we have confidence in it, we have a lot more confidence when we do it with all cash. So it'd be way below replacement costs to not have a debt clock kicking us every month That's the logic of why we do that, because the projects that have gotten in trouble, and I hate to bring it up because it's not a direct comparison to the small bay industrial reconfiguration play, but this type of product, in at least in the multifamily sector, would be done with a floating rate loan. And that's what's hurt guys a lot over the last few years, is watching that interest eat their project alive, even if they had a great execution plan. So we've eliminated that risk.
Can you talk a little bit about the stabilized yield on cost and what assumptions drive that number?
So driving that number are our all-in costs on construction alongside our acquisition basis compared to where we see our lease rates, right? So as Hanson mentioned, we've been working side by side with our general contractor, architects, and engineers on construction pricing, and are very comfortable with our construction pricing where it sits today. In terms of the lease rates that we're underwriting at $1.35 a square foot lease rate for this product type. At the McKemey project, we're getting leases done at $1.40 a square foot triple net. We're seeing leases get done for small bay product in this area as high as $1.45 a square foot triple net. So we're by no means underwriting top of market rents. We think we're taking a reasonable approach on underwritten rents given the conversion aspect of this deal. And so that's how we're arriving at the $1.35 a square foot triple net rents against our all-in basis on the project to get to that 8.5% yield on cost.
How about the 16 IRR and 2-year hold? What has to go right, and what's the downside that you see in those?
So the 2-year timeline is going to be predicated on 2 factors. It's construction timeline and lease-up timeline, right? And both of those, as Hanson mentioned, are risk factors that are very much so real risk factors in any redevelopment or development deal, and hence why we took the no debt approach to mitigate those factors. But in terms of like what has to go right to hit those, is we need to ensure that we're hitting our underwritten rents and we're hitting an exit in that 2-year timeline. The beauty of this deal is when we're not utilizing debt, if we see some softening in lease rates over time, or say construction takes longer than anticipated, or lease up takes longer than anticipated, we don't have a debt clock ticking that's putting a time crunch on that, and allows us some flexibility on where we need to shake out on lease rate or lease up timeline and still achieve a very attractive stabilized yield on cost and a very attractive cash on cash return if market macroeconomic conditions shift for any reason.
And then what does cash flow? Oh, sorry, Hanson, you got something?
No, I think it's worth noting because we as investors have a lot of deals thrown at us that we get to look at, right? And not as an LP, my contribution is 3.9 million and change on this personally. So I get to look at all the deals we look at, and I'm making a heavy investment into this one. And that's why I want to dive a little deeper into that. Us saying a 16, that's not the highest IRR we put out ever. When you learn to play with these spreadsheets, you add a 3% growth factor to the rent, and this turns into a 22. We don't ever want to dilute ourselves. So I just can't stress enough that our attraction to this deal is the basis, and our all-in basis being so much below replacement cost. I'll hold a deal forever. If the market goes to shit in the next 24 months and we're hitting an 8.5 stabilized yield, like that's more than double what we can get out of treasuries today. Like that feels like a safe place for me. So we want to err on the side of a 16 and 2-year execution. That's if we handle these things as we're underwriting them and we're building cushion into those timeframes and prices. We've got a hard bid from our contractor, and we've got contingency built into that. So our expectation is we do better. I just don't want the 16 IRR and the 1.3 equity multiple be looked at as a bad thing. We view that as this is a very safe, prudent decision. And out of the 100 million of capital we're looking to deploy right now, this is our favorite of those opportunities because of that risk reward profile.
Move on to the next slide. I touched on some of this already, but why does this deal work? And Hanson, you've talked about classic Hanson deals before. What does that really mean specifically?
Go-to deal that we've said forever is we buy things below replacement cost and with below market rents, because those are 2 very big levers. Coming out of the GFC, we really learned how guys started playing with things above the replacement cost, and that's not sustainable in the long long run. Like those things come back to equilibrium. So when we started buying industrial for our first fund back in 2018, but mainly the buys through 20 and 21 and 22, everything we were buying was well below replacement cost, and the in-place rents were way below market. And we were able to sell all that stuff to JP Morgan and deliver a 4x multiple to our partners by sticking to those basic fundamentals and saying it's really hard to lose when you buy at a great discount to replacement and when you can bring rents up. So when Chris is explaining that we're underwriting to perform at the bottom or below what we're seeing achieved in the market, that's why this deal works, and it's a classic deal. Because if it doesn't have those two things, we don't buy it.
Mike, can you walk through the 5 thesis points and what gives you the most conviction of what we're seeing here on the street?
Yeah, we've touched on these, so I won't beat a dead horse on each of them, but buying below replacement cost gives us a lot of built-in cushion. So I think the basis play alongside the all cash purchase is what gives us the most conviction behind this deal, because it really gives us a much better risk reward profile by mitigating a lot of the redevelopment risk through an all cash purchase on a well below replacement cost and well below market purchase basis. The other items like infill location, obviously we're chasing the rooftop growth in the Southeast Valley, is seeing some of the strongest rooftop growth or residential growth in the Phoenix metro. So we love the infill location in the Southeast Valley. We've talked pretty significantly about, hey, the small bay product is heavily undersupplied, and we're converting the oversupplied product of bulk distribution into that small bay product because it's undersupplied. And that brings a lot of benefits just fundamentally from having a diversified tenant base and multiple streams of revenue, which lowers our risk in terms of you've got different businesses. Like, so it's not just the multiple tenants, but they're in different lines of business. So if one area of the economy softens, that doesn't necessarily impact every single one of your tenants, or if one of your tenants leaves, it's not an all or nothing setup like a big box distribution center. They're only going to make up, call it 10% of our revenue. So having that diversified tenant base is also a huge benefit. That's just a fundamental aspect of the small bay business plan.
Let's move on. So let's talk a little bit about risk management, exit strategy. We did have one question from Trip. So upon completion, will funds be distributed to investors, or would this be a 1031 exchange? I'll touch on that as we go through the exit strategy. That'd be great.
Sure. I'll address Tripp's question. The plan here is with this asset and another one that we're working on will be at about 1.1 million of the small bay multi-tenant in our portfolio. The sale of JP Morgan was about a quarter of that size. So we've been thematically building towards this. Our intent is to have a sale within the next 2 or 3 years of that greater portfolio. So we underwrite every deal on an individual deal level basis. If this makes sense, and in this case, it's a 2-year execution, that would be our plan exit. If we are at that 2-year mark and we're in the middle of having that assembled portfolio sale and we're seeing good traction with it, that could delay our exit a year or so. And again, this is all assuming capital markets at the greater or institutional scale are supportive. Our fund allows us the ability to exchange into another asset. With our JP Morgan sale we just had, it looks like we're going to return roughly half the money from the roughly 100 million of buying power in round numbers. We will let the deals that we see at that time dictate whether we think there's an exchange or not. But we have been talking internally, the next exit being a much larger one in the 9 figures. We anticipate being a full wind down because our fund has sunsets. This deal being a fund 3 deal, it has a longer duration. We have roughly 10 years in the fund, but our plan is to assemble and have a true exit at this point. And I talked all on that question you asked, Ted, but as far as the risk mitigation, the built-in protections, again, we're probably a little repetitive here, but the basis is what we're really hanging our hat on here. The product conversion component here is it's a very simple construction lift. It's demising walls, it's that office, all that stuff, as we talked about earlier, is very intentional and designed about where the demand sits in the marketplace today. The debt-free component, it also gives us, rather than mitigating risk today, It gives us one other option, being if we see some opportunity or we finish our exit, we can put debt on it. There have been hopes that rates were going to drop. Now, over the last 3 days, it looks like rates might go up this year. But being debt free, we've got a lot of control there. So assuming we execute our plan and we're stabilizing it at 8.5, if we see a scenario where rates get cheaper, that's going to be a huge catalyst or tailwind to commercial real estate in general. That would mean cap rates come down, values pop up. If we have this asset valued in the mid 20 million range, we could go take 15 million bucks out and deploy and leverage that to other opportunities. We could return capital, which could boost IRRs. There's a lot of flexibility there. And then I guess the last two protections on that list being the diversified income stream. I love having 10 tenants, more like an apartment, albeit a very small apartment building. Diversified income is great. Single tenants are awesome when they're there, but the multi-tenant stuff is certainly where I like more of our portfolio.
We got a question from Bruce. What remains to be completed prior to beginning construction?
I can jump in on that. So in terms of where we stand today, we have an agreed upon site plan that we've submitted to the city of Chandler through their pre-tech review process. We've gotten positive feedback from them to move on to full construction drawings and permit submission. We're in the process of finalizing our construction drawings for that site plan with our architects and engineers so we can submit for the permit. Once we have the full CD plan set, it'll take roughly 3 to 4 months, potentially quicker, but the 3 to 4 months is a conservative timeline for the actual permit to be issued from the municipality based on what the municipality is telling us alongside our architects' hands-on experience with the municipality. And then upon receiving the permit, we can start construction, and our general contractor is looking at a 14-week timeline for construction completion at the project. Throughout that entire timeline, like we've already got the site plan established. We've got exterior photos. We're working on renderings. We've got a signed listing agreement with the top producing small bay brokers in the Southeast Valley. So throughout that entire process, we are going to be actively doing front-end marketing for lease as well, right? So we've had success in the past on building strong leasing velocity while we're in construction, similarly to what we did at the McKemmy project. So just want to emphasize that as well. Throughout the entire time frame of the investment, we will be marketing the product for lease, but we'll call it 3 to 4 months for permits and then a 14-week construction timeline.
Okay, cool. Could have a question from Joe. What is one thing you like most about this opportunity, and what is one thing that concerns you the most, Hanson?
I like most our all-in cost basis. I've beat it to death on this call. That's my favorite place to own real estate. Down market, you can lower rents and still hit a good yield on cost, better than your peers that are in at a higher basis. Biggest fear or risk on the deal is just if the lease up took longer, if there was true, I'll say, headwinds that were unfamiliar, worse than the war we're in, and some of these other factors that are making the economy falter more. That is why we're in industrial, because this stuff is like critical infrastructure. It's not discretionary spend. Most of these tenants are going to be doing things that are, I'll say, inelastic demand because they're service or housing or infrastructure related. That's where I land on that one.
Right. Any oversupply risks on the Price Road corridor? And has anyone chatted with any of the top intel service suppliers at all on our team?
So to answer the intel service providers, so our leasing brokers do a good job of staying in front of those providers, as well as staying in front of traditional marketing efforts and staying in front of the local chambers of commerce, et cetera. So these guys this is their job. This is what they do day in and day out. They're out there fielding who's in the market, who's looking for space, and making sure they're staying in front of intel suppliers and out there fielding those types of inquiries. So our leasing broker team, again, we're very confident in their capabilities. They're the top small bay leasing broker group in the Southeast Valley, and they'll be staying in front of groups such as those. What was the start of the question, Ted? Sorry, I apologize. So hard to buy. Yeah, in terms of like new supply or oversupply, there's limited supply in the Southeast Valley of existing small bay product type in general. As you head up north towards the Tempe near the campus or ASU campus, there's a higher concentration of some small bay product, but we're far enough removed from that submarket. We're very confident in terms of this submarket being undersupplied. And from a new construction standpoint, there's only 2 new developments that are targeting bay sizes. There's one, a very small one, an 18,000 square foot development that's targeting bays anywhere from 2,700 square feet up to 6,200 square feet. But the lease rate they're targeting on their new construction product, if their asking rate is $2 a square foot triple net versus our $1.35 a square foot triple net. And then there's also a 74,000 square foot development that's their smallest bay is going to be on the larger end of what we're targeting is 7,560 square feet on the small end. And they're targeting $1.50 a square foot triple net versus our $1.35 a square foot triple net. So both from an existing supply standpoint and potential new competing supply standpoint, we feel very good where we stand from a lease rate standpoint and an inventory standpoint.
I had a question from David Hanson. On any of your projects, have you ever missed a preferred monthly or quarterly return? And have you ever had to have a capital call?
Yes. We've done capital calls and we have not missed preferred monthly or quarterly returns. And I say that because just structurally, I should clarify, we don't distribute the preferred return on a monthly or quarterly basis based on it being accrued. It accrues as the cost of the deal. As cash flow comes in, we make decisions on distributing that or not. So during the lease up period, we won't be distributing anything. We'll be getting the project stabilized. If we have income coming in during that period, we're still going to get through the lease up and basically the execution phase of the project before we start distributing. There are projects we buy that will say these are going to distribute from month 1. And then when it's a heavier lift or construction component, we don't distribute until we're stabilized. And then the distribution mechanism itself is an internal calculation that it's dynamic. It's going to be based on, like if you only have one tenant, we'd probably maintain a heavier, like a 6-month reserve. When we've got a diversified tenant base, we'd have 2 months of full expenses in accrual. In this case, with no debt, that's going to be very minimal. So we're going to have a watermark number that's going to be fairly small. And then on a monthly basis, we distribute every month, not every quarter. And we distribute everything above that waterline gets distributed out to the partners pro rata. If you are in our institutional class and have a preferred return accrued, we'd be paying towards your preferred return before promotes or anything else kick in towards us. And in regards to the capital call situation, a lot of people have a really negative connotation to capital calls. Again, pointing back to that multifamily phase, multifamily operators run out of money, the deal's in trouble, and they make a capital call to keep the thing afloat. In industrial, we will make capital calls because sometimes, not on this particular project, we're able to do it all up front, but in other projects where we're buying something that has some remaining lease term, 2, 3, 4, 5 years, we don't necessarily know whether we'll get a renewal done or if we will vacate the building, do some improvements and bring a new tenant in altogether. So we can't really forecast what that capital requirement's going to be. And we wouldn't want to call capital today for something that's going to happen 2, 3, 4, 5 years from now that we don't know the scope of it. So what's happened in the past is we'll say, here's our operating budget over our 5-year hold, and there will likely be a capital call because of this event that's to happen or occur in the future. When that happens, we'll issue a capital call, and it might be a couple $1 million, but we would know that going in, at least what the range could be. And if we're raising $2 million to put additional capital, it's to secure a tenant and pay the leasing commissions. And by doing that, we're creating all the value for the building. So capital calls are not negative to us. I don't like them any more than anybody else does, from the sense of if it's unplanned, it's going to be, it's burdensome. But we will do capital calls when they're appropriate. We have not done a capital call in the industrial arena to keep a project afloat across our industrial experience starting since 2018.
And I think another important thing to note is that variability is much more impactful on, call it, single tenant buildings as well, because of the fact where you have an all or nothing, someone vacates and you have to put some heavy improvements in order to replace them with a new tenant. The predictability of the small bay, the make ready is on a small bay alongside the diversified cash flow helps mitigate that risk in comparison to single tenant deals as well. So I think that's something.
That's a great point, because when I say we will pause distributions, another thing we've learned over the years that investors don't like is if we're distributing monthly cash flow, we're getting paid on our promote. If I pay you every month for the performance of this building, and then I say, hey, we need 300 grand for this new tenant make ready, we've had pushback of, well, you just paid yourself. We would have preferred you pause the cash flow and let that 300 accrue so you could do this out of operations instead of ask for cash. And we learned this lesson years ago. So that is the approach we take. If it's this type of building, as Pike pointed out, the future incidentals are likely going to be small enough we just do them out of operations. If they weren't, again, being all cash here, we've got the flexibility to throw debt on this thing and fund anything we need. So when it comes to, is there a risk of future capital calls on this building? I don't think so. I think we've mitigated that by doing it all cash up front. If we had a huge unexpected cash need, we can put debt against 17 million of equity and solve it without requiring partners to throw out extra money.
One last question, I'll just throw it out there regarding the 16 IRR. Is that over 2 years? Is it per year? And then talk a little bit about the 1.35 multiple and how that's modeled.
This is often misunderstood. So IRR is the internal rate of return, and you have to have the equity multiple to understand it. That is per year. So what it's telling you and it's explaining is the 1.35 equity multiple means if you give us 100 grand and we do as we expect, we're going to give you 1.35 times that back over the project. So if you take 35% gain and you divide it across 2 years, that's going to be not the same as 16% a year. So why it discounts that is it's putting a net present value to it, saying $1 I give you 2 years from now isn't as valuable as $1 I give you today. So it's important to look at those in tandem. A 16 IRR is saying you're effectively going to get 16% a year once you factor in the time or net present value of money. Hopefully that clarifies that.
Those numbers are net of fees and promote.
All numbers we ever present are always net to LP. I think that alignment is super critical. Deal level numbers look better, meaning excluding fees, but you guys don't care, neither do I. My $4 million is in on the LP side of the table like you. I'm making decisions around what I'm seeing. It would not be fair to expect you to calculate the waterfalls. Every return number we ever speak to is going to be net to LP.
Cool.
Net to limited partner. It looks like we hit the Q&A queue. Thanks everybody again for reaching out to us. As Ted mentioned, you might be hearing from him or others on our investor relations team just to make sure there's no other questions. We only have about $2 million, and I know we've eaten into that just in the last 48 hours. So we're at the final stretch here of closing this one out, and we look forward to welcoming